If you've got 2 million, 3 million, 4 million or more saved and you still feel stressed, you're not alone. What lets you sleep well at night isn't the size of your nest egg, it's certainty. Knowing what you can safely spend during retirement, that you have enough money that you won't outlive, and that a market crash won't leave you high and dry. Here's the one question your $2 million retirement savings can't answer. How much can I safely spend every month for the rest of my life? I regularly meet with pre-retirees and retirees who have 2 million, 3 million, 4 million, sometimes even 5 million, and they're scared to spend because their net worth statement never says what's safe. So in this lesson, we're going to talk about why your net worth is tricking you, the 4 fears no amount of savings can quiet, and how to turn your savings into income that you can't outlive. If it's your first time here, I'm Dr. Amanda. Welcome to the Retirement Income School. This is your place for financial education on how to protect your wealth and generate guaranteed lifetime income so you can retire financially relaxed. Always remember, if you want to chat with me about your retirement income plan, go to retirementincome.school and click the link at the top of the page that says book a Q&A call. All right, let's dive into this lesson, and we're going to start with the lie that almost everyone believes, that your tax-deferred portion of your net worth is all of your money. It's not, because let's say you've got $2 million in a traditional IRA. On paper, that's a $2 million retirement savings, but it was never fully yours. Ed Slott says your IRA is an IOU to the IRS. I really love that quote. Your IRA is an IOU to the IRS. What that means is that once you hit RMD age, the IRS will collect their portion. Let's break this down in numbers. What if your financial statement says that you have $2 million saved in your IRA? But if you're in the 24% bracket, well, that means that $480,000 of that $2 million is the IRS's. So what's actually spendable of that $2 million is $1.52 million. So your net worth just lied to you by nearly $500,000. And what I've noticed for a lot of my clients is that once they realize they have lower net worth than they thought, because a huge portion of that tax-deferred money that they've saved for all of those years is due to the IRS, they start worrying and questioning, is the amount of savings that I have enough? So even though you might have built up 2 million, 3 million or more in your retirement plans, it might not feel like enough. And a big reason for this is because there are 4 fears that surface as you're moving into retirement. And you're not alone. I see them in almost everyone that I talk to. The first fear is outliving your money. If you think about how if you retire at 60 or 65, you could have a 30 to 40 year timeline to fund your retirement. That's a long time with savings that you're afraid to touch because you fear it might run out. The second fear is the market. I know many retirees who check the market multiple times a day, and they base their spending habits on how the market is performing. This can cause a lot of stress because every dip feels like your future is shrinking right in front of you, and it's going to limit the amount you spend if you're worried about longevity. Fear number 3 is not enjoying it. And this one really breaks my heart because this is when you've saved and saved and saved. You've moved into retirement. Now it's your time to spend the money and play and have fun, but you won't take the trip and you won't enjoy the retirement because you're so afraid of running out of money that you won't enjoy a single dollar of what you've built. I once met with a client who had a portfolio of over 5 million and was living from $40,000 a year because they were too afraid to spend the money and they had built the habit of never spending the money. What this could turn into is them giving it to their kids, and their kids will probably have fun spending the money that they save. So this one is a big one where there's this fear that if you spend it, it'll run out. There's this fear to start spending it, and so you don't enjoy the money that you've saved over decades of time. And fear number 4 really ties to fear number 3. Fear number 4 is spending the assets. So you've really spent around 30 to 40 years growing your nest egg. You've worked hard, you've built your assets, you've watched that number growing in your accounts, and all of a sudden now you're asked to spend those assets. And everything fights the habit of saving that you've built over the last several decades. One thing I notice a lot in couples is that there's a spender and a saver. Sometimes there's 2 spenders, which is really tricky because that's going to cause both of you to not enjoy it in retirement. Let's say that you've got the saver who has been used to developing the habit of adding money, and then all of a sudden in retirement, now you're going to start decumulating and spending it, and it triggers this fear watching watching that number go down. I was chatting with a client yesterday during one of my initial Q&A calls, and she was saying, I am so scared of spending the money. I'm used to watching that number go up, and now I've got to spend it, and I don't like to watch the number go down. And this really has to do with the psychology of money and the behavior around saving, and you've cultivated this great habit of saving money over many years, but now you're asked to spend it, and that can be very stressful. And I would say the underlying problem for all four of these fears is retirement anxiety about how much you have, and the anxiety comes from not knowing what comes next. So really it's lacking a plan. You're lacking a decumulation plan. In a lot of ways, it was somewhat easy to build up a retirement income plan because it was pulled right from your paycheck and you got into the monthly habit of that. Now you have no system in place for getting a paycheck into your account every month once you've retired. There's no plan for it. So in pulling this all together, there's a real turning point. What if you knew exactly what comes next? And it's not about a bigger retirement savings. You're probably not at the stage in your life where you're going to grow your retirement savings a lot more at this stage in the game. It's about predictability and control, and in this case, a predictable paycheck that you can count on for life. Imagine if you knew almost to the dollar what lands in your account each month. That would feel very secure. Let me show you a solution. This is something I build for almost every client, and it's standard and good in planning. It's called the income floor. And the income floor just means that you cover your essential expenses with guaranteed income first, and then you invest the rest. So every essential dollar is covered no matter what the market does. Let's break it down. Your essentials are what gets paid no matter what. First, you want to think of housing, the roof over your head. Next, food. You got to eat to sustain your body. And utilities. You got to stay warm and be able to read at night. Fun joke there. I mean, really, you got to think about, we don't want to go back to candles because you can't pay the utility bill. An essential expense is utilities. Transportation. Getting around town, however you get around town, you got to pay for transportation. And insurance. Property insurance, medical, car, all the things. These are the essentials that you need to have covered. They are the must-pay basics that create your income needs. And when you're building your income floor, you want to think about three sources of guaranteed income. You've got Social Security. This is your baseline retirement income. Pensions, if you're lucky enough to have one. And then you want to add a lifetime income annuity to fill whatever income gap is left. So if you have essential needs that are $5,000, but your Social Security and or pension only add up to $3,000, well, you have a $2,000 gap. And then the income annuity would fill that gap. Something really changes when the income floor is met. What happens here is that you set the income floor first, so all your essential expenses are covered, and then you leave the rest invested because it's no longer needed to pay the bills. And now you sleep well at night because you have safety first and then growth. And this isn't just a feeling. BlackRock research reveals that 97% of annuity owners said their annuity helps them worry less about running out of money in retirement, and 88% are less stressed about potential market drop. What this means is that an income annuity gives you greater peace of mind because your essential expenses are met through a monthly paycheck that's coming into your account to take care of your essential needs. So let's look at a quick case study with Sam and Sally so that we can sum this all up with real numbers. And keep in mind that Sam and Sally are just a combination of clients. It's a typical case that comes my way when I'm working with clients who are looking to meet their income floor. First, let's look at their IRA net worth. They've got $2 million in an IRA, but remember, if they're in the 24% bracket, $480,000, approximately $480,000 of that is owed to the IRS. Now, I know there's a difference between marginal and effective tax brackets, but just for the sake of the ease of this example, we're going to use a 24% bracket. And what this means is that they've got $1.52 million to fund their retirement income. Now, let's look at what happens if we take a portion of this $1.52 million and use it to meet an income gap that they have. And we'll just play with various scenarios in my software. All right, so in this case, we're going to say that Sam is 65 years old. They're from Texas. Sally is his spouse, and this is a joint income annuity. And in this case, they were looking at how can we take $600,000 of that $1.52 million to generate an income gap solution. And here they're looking at if they were to take this and immediately turn this income on, they would have $3,864 $4,000 per month. Now, the way that FIAs, fixed index annuities with income riders work is that they have a roll-up rate every year, which makes the income grow the longer you defer it. So let's say in their case, they're 65 and they want to wait until age 70 to turn this income on because they both want to work until age 70 and they're going to turn their Social Security on at that age. Well, watch what happens with this income each year. We said at 65, from this $600,000 IRA, they had $3,840. Now at age 66, that goes up to $4,025 per month, guaranteed for the rest of both of their lives. At age 67, they have $4,316. At age 68, they have $4,724. At age 69, $5,170. And at age 70, $5,657. And you can also see, if you're watching this on YouTube, you can see how the carriers change as we move through time. If they were to purchase an income annuity at 65 or 66 and want that income right away, well, you see that the carrier stays the same for those first 2 years. And then as they keep moving up in years of deferral, it changes to different carriers. And that's because the roll-up rates are different for different carriers. And so we do our best guess when we're looking at filling your income floor of when you think you're going to turn on that income from the annuity. And we're looking at the number that we want to meet at the time that you're needing the income. And you don't have to decide day one what you're going to do. We just make our best calculated guess based on the numbers that we see at the time. This software pulls in the annuities and uses our criteria that we set. In this case, we have enhanced payments, which means that you can have a doubler on the income. Or in some cases on a joint income, you might get a 1.5x payout. And let's break that down, what that looks like. Let's say that at age 70, they decide we want to fill this gap. We are looking for an annual income of $67,000. So you can see how on this $600,000 that they initially put in with this traditional IRA funding that they had, that if they wait 5 years, they're getting more than a 10% payout per year, guaranteed for life for both of them. In this case, let's just look at the illustration and see what that looks like and break it down a little bit. Like I said, they waited 5 years and then they have $67,883 per year every year for the rest of their lives. This equates to a 7.7% withdrawal rate on their ending benefit base at the end of the 5th year of $881,597. That's from the roll-ups that are happening. So initially they had 600,000 and then they get roll-ups, which add to the benefit base. And then there's a lifetime withdrawal rate that they calculate to get this end number of annual withdrawals. Let's break it down another way here. We've got, okay, if they were to not defer at all, they'd have $43,200 of income. And you can see how this just keeps going up because of that roll-up rate. Now, before when I said this is more than a 10% withdrawal of their income to premium ratio, this is 11.31%. So they put 600,000 in and they're getting more than 10% each year, in this case 11.31 of that 600,000. Now, I've talked in previous videos about the 4% withdrawal rate and you can see that this is much, much more. So they're positioning this 600,000 to give them a guaranteed lifetime income that is going to pay them for the rest of their lives, no matter how long each of them live, and it's never going to run out. So here you see that if they both lived, or one of them lived until age 95, this is a joint income, that they put $600,000 in and they're getting paid back $1.764 million. So those are some of the initial basics of how income annuities work. And I was talking about the enhanced payment. You'll see that here, where in this case, you see where if one of them has a long-term care need in the early years of owning this contract before the contract value has been drawn down, they can turn on what's called a doubler in the case of a long-term care need. And then it depends depends on the carrier, but often it's a 5-year doubler based on the beginning contract value, then it would just go back to the original amount. And again, this is for joint income, so this is going to be for both of their lives. I don't want to go too into the weeds here. We would do that during a meeting. I just want to give you an overview of some of the basics of how FIAs with guaranteed lifetime income riders work. One other thing that's important that I get asked a lot, of course, is the fees. These do have rider charges, so they're going to be charging you a fee. In this case, this one is charging you 1.15%. So you see that here. It's very transparent. Those are the only fees in this annuity, and what that's giving you is guaranteed income for life no matter how long you live. This is also giving you the availability to have a death benefit. If, let's say, both Sam and Sally passed at age 72, 73, well, they still have value left in this annuity. And with the FIA index crediting, which gets added, in this case, you see it here, it's going to extend the life of this annuity where the death benefit gets paid out longer. It will not change the income level because the index crediting just gets added to the beginning contract value, the cash value, the death benefit. So again, like I said, if they were to pass at 72, 73, they've still got a big chunk of change to leave to their family, even though they've been receiving income from this annuity. And so I hear sometimes people say that they're worried that with an income annuity, their kids get nothing. Well, that's only the case if the income annuity pays you for a long time. And that's why you're purchasing a guaranteed lifetime income annuity, is that you want it to pay you for a long, long time so that you have that longevity protection. It's not really about a death benefit or inheritance strategy. The only way I would say it's about an inheritance strategy is that you're making sure you take care of your essential needs so that your kids don't have to. So it can be thought of as an inheritance strategy in that way, where you're protecting your kids from needing to come out of pocket to help pay for your essential needs. But there is that death benefit protection if you were to pass before you've drawn down the beginning contract value or the initial premium you've put in plus index crediting. And of course, I know that's a lot to cover in this video. We would go into this in depth with your unique scenario. Again, I just want to give you an overview of the basics of how these operate. So to recap, what we did was take a portion of Sam and Sally's IRA, not all of it. Remember, they had 1.52 million, and we said, let's look at 600,000 and see what that will give you based on different deferral timelines. And we just built their own personalized pension. This is a lifetime annuity that pays a set amount every month for both of their lives, no matter how long they live, and it's not subject to market volatility. They can count on it. It's a contractual guarantee. And then with the rest of their IRA, they can invest and grow. This is going to create a bucket that has an inflation hedge. Because they've got their essential needs met, now they don't need to worry as much about the volatility in the market. If the market goes down, they don't need to draw income from a declining portfolio because they've got their essential needs met through an income annuity. This means that they're never in a state of panic and they can ride the waves of the market because they've got their income floor met. If you remember one thing from this lesson, remember that it's never about the size of the number. It's about confidence. It's about having a plan. And a guaranteed lifetime income annuity is what turns savings into income you can't outlive. And that's true peace of mind. Your next step is to go to retirementIncome.school. Click on the link at the top of the page that says book a Q&A call, and we can build your income floor. What we do is start with an initial consult, make sure it's a good fit for us to move forward. Then we look at your income floor. I have amazing software I use to look at your assets and understand what you have to work with. We do tax strategy planning that's specific to your retirement needs, RMDs, IRMA. It's looking if you need to do a Roth conversion using annuities, life insurance, those types of things. And then we can see, does it make sense to supplement your income with a guaranteed lifetime income annuity? Sometimes it does, sometimes it doesn't. Remember, it's a very unique, individualized process. So again, that's retirementIncome.school, book a Q&A call. And that is a wrap on this lesson. Be sure to keep on coming back to the Retirement Income School, where I'll bring you financial education to help you keep your money safe and make it last so you can enjoy retirement. This content is for educational purposes only and is not financial, legal, or tax advice. Always consult a qualified professional before making decisions about your retirement.